Well, good evening, everyone. Welcome back to the channel. So, continuing our favorite series here on retiring with $1 million in a given fund, we're going to do something a little bit different today. We're going to actually go into a stock that pays as good of a dividend as one of these ETFs that we love to talk about. And this one is going to be Icahn Enterprises, ticker symbol IEP. And the stock is actually trading at close to the price of some of the ETFs that we've been talking about, like JEPQ and so on. So I have the spreadsheet ready. We'll go into that now. So I will start the screen share and we will go into the details. Okay, so again, like I say, if you've pulled together $1 million, say you worked like 30 or 40 years, however you came by it, say you hit a mini lotto or just however you have $1 million somehow, think about the idea of having $1 million, because they say if you read a lot of books, half the battle is the thought, thinking about it, right? So visualize $1 million, however you come by it, working forever, working for not so long, saving, cutting spending, however, $1 million, and you're going to put it all into, in this case, IEP or Icahn Enterprises. So at the current share price of $54.07, this would buy you 18,495 shares. Now, IEP pays about a 15% dividend, which is phenomenal for a stock. Keep in mind, this is a stock. This isn't an ETF like we've been talking about. So $8 a year per share. So you have 18,495 shares times $8 is $147,956.35 per year, or $12,000 per month, which is phenomenal. And we can even go per day. Just say not every month has 31 days, but we'll say 31 just to be, err on the, a little bit more generous side, I guess, or less generous. So that's $400 per day. It's a 67-cent dividend per month if you divide by it's $2 in dividends paid out quarterly. There's 4 quarters in a year, so you get $8. And the stock has held at an $8 payout per year for quite some time. And we'll go into all that dividend history for any skeptics out there. We'll look into how long the stock has been paying this dividend, because I know there are people out there that wonder how sustainable this is. Okay, so in the scenario here, just saying it holds steady at $2. Again, we have about 12,391, and there's a little bit of rounding difference between the column up top and the column here. Say it goes to 150, which I think this used to be 150 back in 2015. So say worst case scenario, it falls back to that. For some reason, they cut the dividend. Then you're still looking at $9,000 a month or 110,000 per year, which is phenomenal. I mean, 6 figures in passive income is like a miracle. So, and you see there, 14.88% to be exact, which we say 15%. So now let's actually look into the stock. And that's strange. I had one live viewer. Now I'm down to 0. I thought this was a popular one. Oh, well, we should get some more live viewers back. Okay, so let's go to Yahoo Finance. And I'm going to show the details of the stock. Okay, so currently trading at 54.07. It's actually up 13 cents in the after hours. The ex-dividend date is March 10th, so if you're not in it, you better get in it quick. It's probably too late by now because you have to be a shareholder of record before the ex-dividend date. So 52-week range, it's very close to its 52-week high, but you'll notice the stock trades in a very tight range. It's bottom point 47.17. The top has been 55.55, so 4 fives. Nice even numbers there. It's been a little choppy over the last couple of years. Now, back in 2018, the stock was actually $65 a share back in April. It peaked in the summer of that year at 77, and then it touched almost 78 in July of the following year before it fell down below 50. And it's hovered around there. It got up to almost 64 in February 21, but the stock has traded very tight around the same range for the last couple of years, or the last few years. The earnings per share are negative, so that's typically not a good sign. But this stock doesn't fluctuate that much. Let's look at earnings. They've missed their last 3 quarters of earnings. Next quarter of earnings comes out May 4th, one of our favorite days. So May the 4th be with Icahn Enterprises earnings, because since quarter 1 2022, they haven't had an earnings beat. Now, a lot of people really look up to Mr. Carl Icahn. He's considered like a very genius investor, almost like a Warren Buffett level, but at a different level than Mr. Buffett. But he's very respected in the industry. So now let's go to historical data and we'll look at dividend history. Dividends, we will go we'll just go maximum all the way back to 1987. So this stock has a lot of history for dividends. I mean, you're talking 97, 07, you're talking like 36 years of dividend history. That's phenomenal. So let's apply this one. So it's pretty easy. The last dividend was in November. We've got one coming up in March. The next one's not going to come till June. But look at this, $2. You see $2 every quarter going all the way back in 2018 when it was $1.75, which increased from $1.50 in 2017. It stayed at $1.50 for many years, actually. Well, they raised it to $1.50 from $1.25 in 2014. It was $1 in 2013. It was actually much lower in 2012. It fluctuated a bit in the year 2011, 2012. You can see here it was 50 cents here, then 24 cents. And then it was 24 cents for a while. Then it was 14 cents. Then it was like 9 cents, 12 cents, 24 cents, 48 cents. Actually, look here. They didn't pay a dividend for 12 years, from 93 to 05. And stocks like these I really like because this is a solid, robust amount of historical data to look at. So I really like that. But going back to 91, 90, going back to like 88, the first dividend ever paid here, according to this, it's 1988, March 25th. So they were paying 50 cents in dividends until 91. And then they cut it to 24 cents, then 12 cents, then 9 cents. Well, they didn't pay for 12 years. Then they started paying again. And then you can see it steadily increased from there. And they were paying dividends all the way through the Great Recession. And then it slowly started increasing. And now it's really a dividend stock. Now, the downside to this, some people talk about their tax treatment. There's like a K form or something that you get. And yeah, the thing is, when you get dividend income like this, you're going to pay tax. But what do I always say? If you're paying tax, you're making money, which is a good thing. So, but yeah, I mean, right now, I mean, I see no reason for them to cut their dividend. We haven't had like what we had in 07 and 08 and 09, where the bottom fell out. And even though that happened then, most companies, as you've seen, they didn't cut their dividends. But in this case, I don't see a repeat of from 07 to 09. I don't see, knock on wood, praying, whatnot. I don't see a repeat of 07 to 09. We've been pretty stable, even though we have all this inflation and stuff going on. I don't see a repeat of that Great Recession. So with that being said, seems like a pretty stable dividend overall. Now let's look at the whole history of the stock. Going back to 1987, it was like $15 and change, then 11. And I believe the stock split a couple times. Now the stock had a huge run up from 03. You can see it here on the chart. It started running up. It peaked in 07 and 08 at 126. And then it dropped to 33, dropped significantly in 08 when the crash happened, the big Great Recession. And then it took a while to really recover. But then in 2012 and 2013, it started really recovering all the way to 110 a share. It got all the way up to 121. Then it crashed back down. And it really has traded in a tight range since then. The highest it's been, like I showed, was about $77 a share. The lowest was about 47 or 50 a share. So really, you want to take the last 5 years. You can see since the pandemic, we really traded between 48 and, I mean, we did go up to almost $64 here, but that was an outlier of the last 3 years. So we've really been between $48 and $55. So that's a tight range. So not a lot of fluctuation, really solid dividend. So it looks good. But the analysts here say it's overvalued. but it looks like we're due for an earnings beat. And I mean, I like this company. I mean, if you're looking for this strategy, I think this is a really solid company to look into. So now what I want to look at, back to historical data, I want to see how many times the stock split or if it has split. Okay, so stock split, and we'll go back to the whole history maximum, all the way back to 1987. Oh, wow. How do I even read this? 10,043 to 10,000 stock split. I'll have to Google this because I'm not even sure what this means. Anyone in the audience want to chime in about what that means? I've never seen a split like that. Okay, let's see. I'm just going to Google as Icahn Enterprises. There's a website called stockhistory.com. Now, this is saying here, since January 5th, 2012, Icahn Enterprises LP, ticker symbol IEP, was split 5 times. Let's just do this here. Here we go, stock split history. Okay, so let me take the screen share back, and then I'm going to go to another tab. This works out pretty good this way. So, all right, stop the screen share here. And then we'll look at this other tab over here, which should be coming up here momentarily. But like I say, I mean, for a stock, this is a phenomenal dividend. You know, just for a stock. I mean, we're accustomed to this like in ETFs, but not for stocks. So, all right, come on, screen. Okay, this website is stock split history. Now, this is showing the same thing that we just looked at on Yahoo. So here we go. Icahn Enterprises has 5 splits in its split history database. The first split took place on May 14th, 2012. This was a 10,053 for 10,000 split. Interesting. Okay, this is going to explain it. Meaning, for each 10,000 shares of IEP owned for pre-split, the shareholder now owned 10,053. So, wow, if you own 10,000 shares, you got a whopping 53 more. So if you want to scale that down, if you only owned 1,000 shares, you got 5.3 more shares. So not a great split, but still, you did acquire more shares. But these aren't the splits that we're really accustomed to seeing. But it looks like they all happened in the same year. You see January here, I guess 43 shares more if you had 10,000. And then March, another 63. It's weird, it's not in chronological order. May, 53. August, another 62. And then November, 59. Okay, so at the bottom of this here, for example, 1,021.87 and change share position pre-split became 1,028. When a company such as Icahn Enterprises splits its shares, the market cap before and after the split takes place remains stable, meaning the shareholder now owns more shares, but each are valued at a lower per share price. So that's probably the weirdest split I've ever seen, but nonetheless, the stock did split. And one of my favorite charts here in the middle of this, split history adjusted CAGR, which is compound annual growth rate. I don't get into that too much on this channel, but that's really what we should look at because that's how you should determine growth rates. Okay, so from March 8th, 2013 to March 7th, 2023, 10-year gap, well, hard to believe. Total return of $10,000 invested with dividends reinvested, you would have $25,499.42 as of today. That is a total return of 155% and an average annual return of almost 10% over 10 years. Starting price, ending price. So you see the end price is lower than the starting price, but because of those dividends, you have a positive return if you reinvested them. So now with that, jumping back over here, let me see. Jumping back over here, we are going to go, yeah, it's complicated with the tax thing. I'll look into that next. But what I want to show, I want to illustrate like I do on each of these videos in this series. I want to show if you did the drip program instead. Had a sneeze building up there. Okay, so instead of taking this payout, if you were just going to take your $1 million over here, column D, you're just going to take your $1 million. Let me center this. We're going to have about 5 or 6 years of sample data. So you're getting 14.88%, and you're just going to reinvest it. Say the stock does nothing. So there's your 148,000 in your first year, and then you reinvest again in your second year. Come on. In your second year, and this is what I love about compound interest, also known as the dividend snowball effect. You have 1,319,741, and then subtract 1,148,800. So you have basically an extra $22,000 in free money because of compound interest. Because if this was just simple interest, remember, you would just be adding 148,800 to it. And then you would have 1,297,600. But it gets even better. See, in year 4, now you're at 1,516,119 minus the 1,319,741. Now you're at 196,000 per year. So you see how you keep making more free money. The more years you do this, and watch this, I'll take a wild guess here. You will have doubled your investment by year 6. Look at that, $2 million. So just by reinvesting in the dividend, saying that the stock stays flat, which for the most part, it has. But you know what? Let's just say it didn't. Let's do that example here. I like a good challenge. So let me move this over here. Insert a column over here. Uh-oh. Ah, here we go. Wait, what did I do? Oh, I didn't want to do that. I wanted to insert it over here. Oh, I'll click on this column, I guess. Okay, insert. All right, did we do this right? Okay, here we go. So in this example, you have $1 million starting out. Okay, so you buy in, and say year 1, you're buying in at 54.07. So you have 18,495 shares, right? Say the stock goes down to $50. Come on. So, you're in trouble now. You just lost money. See, this doesn't work. I told you. You should have followed your instinct. This doesn't work. Actually, not true. Some of you will say that though, and that's the mentality we have to break in these videos. Okay, so in this situation, the stock dropped. Now you feel like a fool because you lost, you lost 75,000, which you may say when you start to, you see when people start to think negatively, it spirals. But you need to turn that around when you think positive. You need the positive thoughts to spiral. Reverse it, flip the script. So, but what somebody would say thinking like this is, I just lost 75,000. See, I should have not done this. I should have known investing was risky. But cancel that thought right there. Like envision a cancel button and press cancel. Okay. So here's what happens. Okay. So 18,000 shares, right? 924. So the stock dropped, but the dividend didn't change because I just showed you on the last screen, right? The dividend has not changed. And the stock, what did I show you? 10 years ago, the stock was trading at $60 a share. Now it's trading lower, but somehow you still have a positive gain. How is that possible? Because of the dividends. So here, your 924,000, guess what? You're still getting a 14.88%. Still getting a 14.88% return, right? So look at there. You just made your money back. You thought you lost 75,000, but you actually gained 62,000, right? It's like magic. So you went from down 75,000 to up 62,353 because on your 924,000, you made $137,603 in dividends. Now, watch this. The stock is going to say it's going to recover. And watch this. Forget this what we're saying here, but take just the share price or the number of shares. You have 18,495 shares, right? So when you're reinvesting the dividend, 1.1488, you now have 21,000. I don't know why it's doing it in currency, but shoot, I don't want it in currency. Anyway, these are shares. These are your number of shares, not currency. Okay. So let me see if I can move this to another column over here. 18,495. And then, oh, see, it knows what I want to do. Okay, good. I like it when it actually knows what I want to do. That's what I like about spreadsheets. Okay, so watch this. So in year two, your shares, right? So we said, okay, they dropped down to 50. But in year two, because you have this many shares, just track with me here. Let me see how we're doing. Oh, yeah, right. Some more live viewers. I'll keep rolling here. It's all about changing mindsets with investing, right? Okay, so in year two, now I want this to be currency over here. And I'm getting on a roll, so this could go for a while. Let's see what time it is. Oh, it's after 11 on the East Coast over here. Okay, so and then in year three, 1.1488. And then move this over here. And there's so many people out there that are better with spreadsheets than I am. Some people probably watch this and say, "Oh my God, you could do this so much quicker." But I like to do it the way I do it. So okay, I don't know why that's not putting a comma there, but whatever. So now, okay, the stock, and this is where we were like 4 minutes ago. Now the stock is going to rebound and say it's going to be, instead of times 50, it's going to be, say the stock is going to go back to $55 where it was before. Even if it stayed at 50, watch this, you still made more money in year three because of the dividends, right? The reinvested dividends. You see the effect this has here? So you're at 1.22 million, right? Whereas you were at 1,062,000 the year before. So you made 158,000. So you're still where you would have been if you had your original million. But now, like I said, for this example, the stock price is going to recover. So now you gain $5 a share and you've got more shares than you had before from this effect. So your 24,408 shares that started out at 18,495, you gained 6,000 more shares and you made $5 and extra because it rebounded on those shares. So then you made an extra $30,000. Now, see, a stupid person that doesn't want to be rich would have sold out. They would have said, "Oh my God, I lost 75,000." And I can only imagine how many people panicked during the Great Recession and did this, because that's the psychology that the media makes people think on. But that's where you gotta not think that way. You've gotta, like I say, think like the rich. If you want to be rich, think like the rich. So you see, by staying in here and being patient, you turn the whole situation around. Now you're rolling in money, and it's just going to keep going from here on. So, like in year four, look at there, 28,000 shares. And remember, the stock really doesn't fluctuate that much. So watch this. At some point here soon, you're going to be doubling your original investment. So look at that, 1.5. And this is just saying that the stock doesn't increase. But say by this point, say the stock ran up another $3. So now you're here. And then give it another year, and you're going to have doubled your original investment, despite losing 75,000 in your first year. But the thing is, there's so many people that will focus on, they'll see a $75,000 loss, and that will just stick in their mind, and that's all they'll see, instead of what you see right in front of you. It's like you can double your money in a stock, and you'll never think to sell it. But once that stock starts dropping, oh, all of a sudden you need to sell it. That's the mindset we've got to break. So look at there. By year six, you would have doubled your money. Now let me go back to some comments here. Okay, so the tax situation. Because I wouldn't be doing this stock any justice without talking about the tax situation here. So let's do this now. Go back to, well, just let that sink in there for a second. And I'm going to pull up, let me see here. Icahn Enterprises. What's the tax filing? Because this does come up when I talk about this one. Tax filing. And we were just talking about this on my podcast yesterday. Okay, I'm going to pull up an article from Seeking Alpha, which is almost a year old. And then let me jump over to that screen. Stop screen. We're going to go over here. And wow, this video is coming along really well here, almost half hour. Time flies when you're having fun, right? And feel free to comment, anyone that has any questions or concerns or feedback or super chats. Those are always welcome. Oh, now Seeking Alpha wants me to create an account. I'm not going to do this. Come on. I don't want to do this. Let me try to do this here real quick. Okay. Because many investors do not correctly understand the Icahn Enterprises LP historic price performance and the $2 quarterly partnership distributions, they avoid buying. So the gist of it, because this article is going to be a pain here, let me just pull it up some other way. What it was saying essentially, so it's basically a limited partnership. So, and I've been in one of these before. Basically, they send you a tax form and you have to claim these like as ordinary income. So you're going to get taxed a little bit higher. That's very common with dividends, actually. Let me pull up the site, themoney.co. So you're going to get a K1 because it's a limited partnership. So Icahn Enterprise offers a current distribution yield of 14.6 and a way to invest with Carl Icahn in South Florida's Sunny Isles Beach. The company is a master limited partnership, which means at tax time, investors receive a K1 form rather than a 1099. Yeah, to me, that's not a big deal. Like I said, you're making money, you get taxed. So let's see. What's all the hubbub about this? Okay, this just breaks down what he's invested in. Okay, now that we have that, let me see. Okay, a K1 versus 1099. Let's just do this one here. Google. Over here. Let me just leave that up for a second, and then I'm going to find um, K1 versus 1099. This is what we need to see here. Tax rate. Okay. So once I find a good article here, I'm not finding a percentage. Oh, here's what it is. It's at your effective income tax rate. So those of you that are really rolling in the money, you're going to pay a higher tax rate because you're in a higher tax bracket. But you know what? That's to each their own. TD Bank. Does TD Bank pay a good dividend? Let me see here. Oh, you always have good observations here. 100,000, 1845 shares. Let's check this here. I think you're right. Yeah, I mean, you could always simplify it to 100,000. I just, doing a million, that kind of gets attention. So yeah, at 54, well, 5407. I think it's at 5407, but it would open at 5420 tomorrow. 5407. Yeah, so you're right, about 1,850 shares or so. 1845 times 8. So annually, that would pay. Actually, I come out with. I'm not sure how you're getting. Yeah, you corrected yourself there. 1230 a month. You're right, exactly. I don't know. So for TD Bank, I mean, do they pay a good dividend? I'm not sure what the situation is there. I do know I like their brokerage platform, TD Ameritrade. Unless you're talking about this Toronto Dominion Bank, they pay 4.3%. But I'm thinking here in the States, TD Bank, they're not publicly traded. I don't think. How about Ameritrade? Yeah, so that's it. That Canadian one. Yeah, that's okay. But I mean, when you can get like double-digit dividends, I don't know. Like all these people that like this, what is it, SCHD? I had a commenter that said that's the best one. I'm not seeing it because I mean, when you're getting like a 4% dividend and you can have like 10 or 15% in another fund, for me, I'd much rather have that. Now, golf is a really good one, and I showed how the dividend payouts have been consistent even through the Great Recession, like the last 15 or 16 years. But the expense ratio is probably one of the highest ones I've seen on these funds. So I think from that standpoint, SVOL is probably a better one, but SVOL trades about $5 higher. But I think SVOL is probably my personal favorite. That one and the JEPQ. But as far as cheapness, it's like $22 a share right now for the SVOL. So bang for your buck. That's probably the best one you can get. So now let's see here. I'm going to try to pivot over here. Yeah, I mean, it depends on, taxation and stuff. So, all right, let me go to this screen here since we want to talk about tax here. Um, this is going to be okay. Motley Fool has a good article, the Schedule K1 form explained. So here we go. So what it is basically, if you're invested in certain kinds of partnerships, LLCs, or receive income from some kind of trust, you get a Schedule K1 from that organization. Okay. MLPs and LLCs. So what happens because these entities don't pay corporate taxes, the distributions paid to investors may be treated differently than dividends paid by corporations. A typical corporation's regular dividend is taxed as long-term capital gains, while much of the income paid and shown on a Schedule K1 can be classified as regular income. That means it's taxed at your effective tax rate, which is often much higher than the 15 or 20% long-term capital gains. You know what? For me, I don't care because I'm pretty much at that rate anyway. And if I make a sale and I take the long-term capital gain, I don't mind a couple percentage difference. That's not going to preclude me from investing in something like that. Now, I do appreciate that so many people in the audience have pointed that out because that is important. If you're making like 170,000, you are going to be in a higher tax bracket if you're following the strategy. So that will impact you, but still, that's where your better options are probably SVOL or some of those other ones because that is a downside to this one. So that is a good observation for those of you that have made that one. And that's probably why a good reason why. Oh, and there you go right there, SCHD. Yeah, it's qualified lowest tax rate. Yeah, I agree. Yeah, I would rather have the qualified versus the non-qualified, certainly. 450 a month, that's awesome. See quarterly. Well, whether they're yeah, I like monthly better actually. Um, yeah, because I mean most bills are monthly, right? That's the idea, like with the SVOL and stuff like that. So anyway, well, good session here. We hammered that home pretty good. Yeah, there's a lot of fans of the SCHD, but what I saw with it because I did a video on it. I just don't see that it's one of the higher dividends. I'm going to look it up again here. The Schwab U.S. dividend equity, 3.8%. So unless there's something I'm missing, when I can get a 17% dividend, I just don't know the appeal for the 3.8%. That's the only thing I don't get. Yeah, exactly. I mean, I would rather have monthly versus quarterly any day. But the SCHD, I mean, if somebody could explain to me, what's this one? VIG? If somebody could explain to me, because I don't understand like the 3.8% on the SCHD, it's one of the most popular funds on here. Oh, Kager, is that because of the fund actually appreciates in value? I think I said that. Let me see if I look at it. Well, I'm looking. So 5 years. Yeah, it's up 44% in 5 years. I mean, that's good if the dividend grows, but if it's growing from like 2 cents, LQDW. You know what? Some of these comments, if you guys want to leave these in the actual comments when the video is done, I'm going to keep adding these to the list to do more of these. I'll keep the series going as long as I can. Let me see here. LQ, LQDW. iShares investment grade corporate bond. Ooh, another bond fund. Have I talked about this one before? It's not giving me a dividend on here. I'm just looking at the iPhone. Oh, 16.62%. We'll have to check that one. So yeah, SCHD, I agree. The appeal on that one is the Kager. Oh, 8 to 10% growth. But you know the thing with that, it's like bonuses at work. If your job gives you like um, say you make $100,000 and they give you $1,000 bonus, which is crap, right? If you make $100,000, and then the next year they raise it to $1,100, then they can say, "Oh, we raised the bonus 10%. Look how awesome we are, but it's only $100. So the thing is, if the dividend starts out low, yeah, those increases are nice, but there's better dividends. Not really. That's just an example. I mean, most of them are crap. I wouldn't even call it bonus. The bonus, you have to invest in dividends to get a bonus for most jobs. That's why, like I'm saying, you got to invest in dividends to get the bonus because your job won't do it. That's kind of the running joke. Or do like a sports league at your job, and then whoever wins gets the payout, and that's the bonus. That's the running joke. But anyway, that's just one example. Yeah, bonds. Oh, I'll have to validate that one. That LQDW. I just look at that one real quick, and I might do one of the next ones. I might do it on that because these bond funds, you kind of have to really go into the details to see LQDW. Let's see. And what I like about doing these is that a lot of you all point out funds that I haven't really heard of. So it's like a community. I mean, we're all kind of sharing ideas here. So let's see here. LQDW. Fine. Why is it not coming up? That's weird. Oh, here it is. I want to say I've heard of this one before. LQDW. Okay, yeah. So let me just real quick, and I guess this will be a preview for one of the next videos I do. But I'll talk about it here since it came up. If the M Ariel, what is the M Ariel? I'm not a big bond person. And that's the thing. Like when I hear bonds, my brain just kind of like I'm just much more of stocks and equities. But some of these, like another one that I did, what was it? The TLTW is a phenomenal return. It was like 21%, I think. So let's look at this one real quick. This will be the last one we look at here. iShares. Okay. So I'm going to have to actually go into the details here. Historical data. This is 33.57 a share. It's supposed to open at 34 tomorrow. The futures are mixed tomorrow. We got hammered today because Jay Powell, Fed chairman, he's talking about how inflation, we're going to have to keep raising rates, which it's funny. Don't get me going on this, but the rates, raising rates, I mean, a mortgage is like 7% now for a 30-year mortgage. Raising the interest rates are not making a dent in inflation because now my theory, and I'm not one of the experts that's in charge of this, but my theory is that the inflation was driven by all the spending and stuff that we've had. So the Fed can raise interest rates to 10%. All they're going to do is crash the economy, and I hope there's not a housing crash on the horizon. I really don't, but I mean that wouldn't be good. But anyway, let's look back here at these. So over the last 5 years, let's see. You're probably right. In fact, I think you are. September. Okay, we've got. Let's see. Oh, they just declared another one in March, but it dropped. I'm feeling like I talked about this one before. Look at that, 9 cents, almost $1 dividend in November. That's phenomenal. I wonder if the fluctuations caused by like the I series returns. 6. So I'm going to take these first 6 months here. So divide this by 6. That's 60 cents a month on average. That's 723. I feel like I did talk about this one. Divided by 33.57. I'm getting 21.5% again. Now, if you want to be conservative here, 46 cents times 12, that's 559 divided by 33.57. That's where you're coming up with the 16.65. But you look back here in the last 6 to 7 months of sample data, it's been much higher. So it's closer to 21%. And in fact, I'm pretty sure this was the one I talked about in that one of those last videos that I did last month. So that's really, 21%. I mean, you're not going to beat that. That's awesome. So with all of that being said, oh yeah, well, I was just showing the chart there on Yahoo. Let's see, what do we have? SCHD is good for younger folks. Honestly, I think the higher dividend returns are good for younger folks. I'd take the 21% right now. Oh, the housing crash already started. Is that in Canada or is that everywhere? Well, it has. I mean, it's started from the peak. We're not quite. The values have fallen probably, I don't know, 15% from the peak. But I just don't want it to get like 2008. That was no fun. So yeah, TLTW, I did a video on that too. I'll link those in the description here. But as far as that, we've been going for 40 minutes. Great session here and great feedback, great questions. Always love doing these videos. Thank you all for tuning in. If you like that, please remember to like, comment, and subscribe. What's this one here? Australia, hammered, getting hammered. Oh yeah, I'll have to look into that. I've got to look more internationally because I'm too much like, as far as investing, I'm too much based in the States. And we've got a lot of crazy laws here and stuff. So the crazier things get, I'm going to eventually look more internationally. But anyway, thank you all again for tuning in. Great session. Like, comment, and subscribe. Spread the word, and take care. Keep an eye out for the next video in the series. I'll have a surprise fund. Thanks. Take care.